Wall Street is retraced from its peak levels of November. The S&P 500 rallied by almost 9% amid optimism about the strong likelihood of the Fed's rate cuts. No wonder the benchmark indexes are currently going through a correction. Wednesday was no exception. The major stock indexes lost more ground. Despite encouraging evidence that the US labor market is cooling down, investors want to play safe ahead of the crucial non-farm payrolls, which are due on a Friday. Besides, a decline in the energy stocks put pressure on Wall Street indexes. Yesterday, oil prices slumped by 4% because stronger than expected growth in the US petrol inventories aroused fears over energy demand. As a result, the key stock indexes went sharply down. The S&P 500 lost 0.39% to close at 4,549 points. Before the opening bell, Wall Street indexes traded sluggishly and mixed. The Dow Jones remained under selling pressure. The S&P 500 and the Nasdaq rebounded, according to the baseline scenario. The S&P 500 is expected to trade in the intraday corridor between 4,530 and 4,575 points. If the peers assert their strengths, the index will head up to retest 4,498 points. The bull's dominance will push the price to 4,598. Wall Street is going through a downward correction, and the labor market data still reinforce the market faith in the Fed's pause and a decrease in the interest rates in March. Yesterday, this viewpoint was confirmed by the ADP employment report. The US private sector added 103,000 jobs in November, much below the consensus of 130,000 new jobs. The report indicated soft hiring in the United States on the next day, after the JOLTS job openings report logged contraction in vacancies in October. For the time being, the data mirrors a slowdown in employment, though it's not an obstacle yet because the economy remains on a sound footing. Nevertheless, traders are worried as analysts warn against over-optimism. The S&P 500 took a hit from a slump in oil prices. The energy sector fell by 1.64%, the weakest intraday result among 11 sectors of the S&P 500. The telecom sector dropped by 0.93%. Nvidia shares plunged by 2.3%. Amazon and Microsoft shares declined by 1%. Today, futures on the stock indexes traded mixed in the New York pre-market, though making efforts to recover. Stock investors are in the wait-and-see mode, awaiting the non-farm payrolls that will provide the grounds for a market response. The weekly update by the Labor Department was dubious compared to the previous ADP employment report. The number of initial jobless claims in the United States rose by 1,000 to 220,000 last week. The market has projected growth to 222,000. The actual figure is the second biggest score since September. The market response to the report was subdued ahead of a huge batch of the official employment data. As for separate stocks, shares of Google's parent company Alphabet jumped by 2.9% in the pre-market on the next day after the rollout of the most sophisticated version of artificial intelligence. Shares of advanced micro devices rose by 2.2% before the opening bell on the next day, after the chip manufacturer had estimated that the market of AI processors would amount to $45 billion this year. The US dollar index again is given in to the firm euro, the pound sterling and the best performer, the Japanese yen. The index tried to stay at around 103.90 in the European session, however it slipped by 0.4% in the New York pre-market to open at 103.70. The instrument is expected to trade in the intraday corridor between 103.50 and 103.90. The most pessimistic scenario suggests that the index could fall to 103.20. The yen has come under the spotlight today. It has recovered by 1.7% against the greenback. It happened after several policymakers from the Bank of Japan, including the governor, sent a clear message that the policy of ultra-low interest rates was coming to an end. Commodity currencies also grew against the US dollar today amid a rebound in oil prices. The Canadian dollar was badly bruised yesterday, and the loonie weakened after the policy meeting of the Bank of Canada. The loonie was also hurt by the firm US dollar and the slump in oil prices. Today, the Canadian dollar remains under selling pressure. The USD CAD pair opened at 1.3590, having skidded to the closing level of yesterday. The intraday corridor for the instrument is seen between 1.3560 and 1.3630. The Bank of Canada maintained the overnight target rate at 5% and opened the door open for a new rate hike. The board was still concerned about stubborn inflation, being ready for more rate hikes, and the policymakers summed up their policy decision. The regulator wants to see a further sustainable slowdown in the headline inflation. Besides, the Bank of Canada said on Wednesday that the labor market became less tight and employment growth stalled in the middle of the year. As a result, the economy does not tolerate excessive demand. Markets are betting that the rate cuts could come as soon as March and are forecasting a 25 basis points rate cut by April. Governor Tiff McClam said that monetary easing was still out of the question because inflation is still way above the official target of 2%. As for the crypto market, the bulls are loosening their grip and Bitcoin slipped to 43,100, the lower border of the range. Later on, the price rebounded a bit. The token opened the New York trade at 43,340, 1.12% down. Popular altcoins are trading mixed and quietly today. Despite intraday losses, the buyers managed to keep the price above 43,000, and the intraday corridor for today is defined between 43,000 and 43,700. Next upward targets are seen at 44,100 and 44,400. Important targets for the sellers are 42,600 and 42,200. The clock is ticking down to January 10, when the U.S. Securities and Exchange Commission will have to bring a verdict for ARK Invest application, the first in the line. According to informed sources, the Commission is poised to approve the application and perhaps some of the other 12 ones in the new year. This information correlates to Bitcoin's rally. Until real verdicts are now delivered, downward retracements are imminent. Our video review is over. Feel free to ask any questions. We are always open for your feedback. Good luck in your trading and see you online tomorrow on our InstaForex TV channel.